topic today is clearly the management services, and in the conference of tax VUCA, I don't think so. This topic, one of the most uncertain in terms of availability of deduction, the mechanism, how much I should charge, the methodology, what I should follow, uh, cannot be ignored when we do this sort of a conference. And therefore, we chosen, especially the topic, what is management services or a cross charge. Now, yesterday somebody was explaining to me that we had gone through this management services topic and we had a lot of pains to explain to the tax authority that why it should be allowed. Well, you are still making understatement. Pains is not the word. It's actually something different. And when I always looked at it, this sort of a topic, in India, the tax matters or the tax investigation is not less than police interrogation, right? And this topic is what I have evolved, a theory of 5 W's, which one needs to be really concerned about when we talk about these topics. Which are these W's are clearly what tax authorities really look at it before they could allow you any deduction or ask you to charge more on a management fee side to your subsidiaries outside India. So which are those W's? So first is why. Second, whom? Whom have you, who are the parties to the transaction? Third, when are you going to pay? Fourth, what quantum are we really talking? And 5, which are the regulations that you need to really follow? And really we look at it when you actually get into a transaction of cross charge or management services. Let me now deliberate on all of this, and I have joined with the esteemed panel to give the perspective from 3 different jurisdictions. US, of course, is the most critical because we have a lot of US multinational working out of India. Then we have 2 significant European jurisdiction, Italy and Germany, to talk about the perspective of management services in their jurisdiction. So, let's get into the presentation. What we intend to cover is the first, a simple case study to talk about, that headquarters are based out of India and they are in turn charging either management fee or charging towards a license fee or a royalty to an Indian entity, and what could be the repercussion of those transactions. We would also deal with a situation exactly a reverse, that Indian headquarter companies are charging for a management fee or a license fee or a royalty to their subsidiaries outside India. What could be the repercussion in that context? So both these case studies is what we intend to cover in this particular topic. So let's come to straight India perspective. Now when it comes to India perspective, clearly issues around management fees are significant. Each of the legislation, whether it comes to a transfer pricing, which is primary one, or comes to a customs, or comes to a GST now, are the issues which have been raised in the context of this topic. So let me now therefore start addressing all those 5 W's which we have raised the questions about. First one is this: why this is being paid? The first significant question being put to every company by the tax authorities: why are you making this payment? So what benefits have you actually received for the receiving of these services or for payment of these service charges? Therefore, the first thing that we need to be really been establishing, that what benefits and why are you making this payment to a parent entity? Did we get any support? Is it towards IT support services? Is it towards management support services? Is it toward the brand that you are using? Is it that know-how that you are using? Why are you making this payment? And the first questions always invariably asked by the tax authorities in every assessment, that why are you making this payment to your headquarters? Second, who are these parties? We have had multiple sort of shareholding pattern, typically either through Mauritius to Singapore, now through Netherlands. And when you have this sort of a holding structure, but the management fee is paid to some other entity based out of some other jurisdiction. So are they related in somehow? More importantly, what's the role played by that entity to whom you are effectively making this payment? Are they really incurring only a cost and trying to distribute amongst all the subsidiaries companies where they are working, irrespective of any role being played in relation to supporting the business or the operations in India? So who are these parties to whom you are actually making the payment? Third, when are you making the payment? In the first instance, now under the GST law, are you really making the payment? Because we have a concept of deemed supply, that once you are a related party, whether there is a charge or not a charge, it could be considered as deemed supply liable to GST under reverse charge mechanism. And therefore, that is a third issue, that when are you going to make the payment? Is it a continuous supply of service? Is it something which is one-time supply that has happened? Therefore, the third issue which continuously comes up, when are you making the payment? And the fourth one, what quantum? This is another biggest of the issue. What quantum, right? First question which is always been asked, that did you not have anybody to provide the same sort of a support services in India? Why you needed to go out of India and take this sort of a support at very high price? Because we all know that if I want to appoint a consultant in India to take some consulting services for a business related aspect, you may get a better price being in India as opposed to paying that in dollars to an entity outside India. So therefore they always ask this question, that why are you making such a large payment? Is there a need for you that you really go out of India and avail these services? While we have a settled law jurisprudence in India that the tax authorities should not sit in and wear the shoes or should not sit in the chair of the businessman, that from whom and where he should avail the services. But when it comes to a transfer pricing, you will have to do the justification that why effectively you are going out of India, availing the services from your related organization at significantly higher price when you could have availed the same set of services in India. And the last question which comes up, which are the regulations? Very important. Which are the regulations in the context of this topic are very critical. The first one being the transfer pricing. You will have to establish that this is being paid on the basis of arm's length principles. So there is no set mechanism or the methodology prescribed for this management services. What does OECD tells us? OECD tells us that for direct cost you can charge directly, and for indirect cost you can have an allocation key, and that would decide on what basis you are allocating. Now that allocation key could be simpliciter as cost plus mechanism, or if there is some value based services being provided, then you will have to look at it, can I use some different allocation key? And as soon as you use the different allocation key for this indirect costs which are incurred outside India, the authorities in India will definitely ask the questions, why is this different allocation keys and what are the value added services or value based services that you have received from headquarters. When it comes to a quantum also, on a transfer pricing perspective, one issue again comes up, that as a shareholder or as a holding company, was that not a role of them to anyway support you, your businesses? Would they expect to charge you something for providing the support which was anyway expected from your parent? And if that be the case, then why are you making this payment from India to an entity outside India? So there are the transfer pricing regulations, the methodology to be adopted, and what is that quantum to be justified is one of the tasks that we are going through on every assessment. Second regulation, which is very critical, is the customs. Now when it comes to a customs, we have seen that when we have obtained a SVB order from a customs authorities, we have declared in that form that we file that we are not going to make any payment beyond the value of goods which I am importing. Right? Now, as soon as the headquarter decides for the purpose of compliance for the transfer pricing regulation to charge something to an Indian operations, what would happen is that they would charge for Indian operations. Now we would start making the payment in addition to value of goods to our supplier who happens to be a related party or associated enterprise outside India. And in the SVB order, we had already declared that we are not going to make any payment beyond the value of goods. The first implication is that SVB order will not have a validity because the declaration that you have made that you are not going to make any payment will not hold good as soon as you start paying for a management fee. The second one, then the customs authorities would come and tell you that you have undervalued the goods for the purpose of customs duty, and under the guise of so-called management fee, you are making this payment to a related party. So please be ensured that as soon as the management fee being paid, you come into, look at all your SVB declarations, go and tell your customs authorities that we are going to pay this management fee, and please revise your SVB order. This management fee is nothing to do with the value of goods. This has been paid only for the purpose of some services which I have received from my headquarters in relation to the management support that I get. So the first caution that you will have to go to your SVB authorities and get the revised order. Otherwise, believe me, you will have a issue qua the customs duty demand saying that this is nothing but a payment under the guise of management fee, but eventually only for the purpose of value of goods that you have imported into India. And the next implication is under GST. Now GST is something which is very unique. We understand that when you are making the payment under management fee to your headquarters, you would pay a GST under reverse charge mechanism, and those which are entitled for a credit will avail that as an ITC. But what happens when you are not making the payment? And more importantly, the transactions like a license fee or a royalty. We have already in Mumbai, the GST authorities have issued the large notices for all who's who in the country, asking that you are allowing your subsidiaries to use the brand without charging any consideration. That is a deemed supply under Schedule 1 of the GST law, and therefore you are required to pay GST on an imputed value. Now believe me, would that not issue come up even in the case of import of services? It would come up. You are a related party. If you are a related party, you have a brand to use, you have a license, you are getting some know-how. More importantly, you are getting some management support. And to address your income tax issue, you are not claiming any payment towards management fee because you don't want to go through a transfer pricing audits and the justification. You said, I will not pay any management fee, but that definitely may not be the good answer when it comes to a GST issue, because you will have to determine in terms of section 15 read with rule 28 a specific value for the purpose of this management support and discharge GST under reverse charge mechanism. And that's a big implications that many of our clients have not been really noticed in that context and need to actually start looking at that and paying this amount under reverse charge mechanism as a GST. Now apart from tax, whether it's a transfer pricing, customs or the GST, we would also have an implication in the context of FEMA. Now, and we know as yesterday we asked, there are so many ED investigations and so on and so forth, what is happening? The first question, if you can't establish before any of these tax authorities right that these payments are justified, these payments are effectively being paid for availing certain services from my parent company, then these payments won't be justified even for the purpose of FEMA regulations. Please understand, then while you would have treated this as a current account transaction, you are making this payment, but if no underlying services have been received and that cannot be proved with the documentation evidence, this would be a fit case even for the purpose of FEMA violation, and therefore this issue of management fee will not only lead to some tax demands, could potentially have a regulatory issue under FEMA as well. And therefore, in overall perspective in India, this topic of management fee is very critical topic, and we have always seen for many of our clients that the documentation which are required to be maintained in support of this management fees are missing. Either there are no agreements between the parties, there is no documentation to establish that this is actually the support which I have received from my parent entities. There are absolutely no, in terms of any call book or a conference call details or any notes or minutes of call, minutes of meeting, nothing of that sort is maintained to eventually support why such a high price is paid in relation to this management support. And we believe that's the key when it comes to establishing that this is what the management fee that effectively we have paid. Therefore, what are the measures that we believe that one should be really looking at it? One, thorough identification of the transactions are key. Different nature of transaction. It is pure support. Is it something support plus value-based services? Is it routine transaction? It is non-routine transaction. So thorough identification of transactions. Second, consider filing an application before APA and SVB to obtain a certainty on this topic. While I may not want to, therefore we have not added specifically AAR for GST, because we have seen how the AAR rulings have been passed in India under the GST law. So there we have stopped it saying only APA and SVB, which are far more reliable and far more certain as compared with the AAR under the GST law. Third, enter into a detailed agreement with the AE specifying the service to be received and fees for the same. Everything should be clearly documented, clearly been provided for in terms of documentation, and then only this transaction should have been incurred and the payment would have been made. And then last, maintain the evidence in respect of services like email communication to justify receipt of services from AE. If you don't have this, all the documentation in place, we would have a nightmare to effectively go with the tax authorities or any other regulator that these are the genuine payments which have been made from India to an entity outside India. I will take one more minute and then hand it over from a US perspective that the similar situation exists when it comes to an outbound transaction that Indian industries or Indian conglomerates have invested outside India. All of these four aspects are very critical. First, transfer pricing, you will have to justify that this has been charged on an arm's length basis. Customs may not be as a great issue, but now even for export of goods, we have export valuation rules. And if you are not valuing right for the export purposes, that also may have an issue for the purpose of customs. While there are very few products which are liable to export duty, but there are a lot of incentives which have been granted based on the FOB value of goods that you have exported, like drawback, like advanced license schemes and whatnot, or MEIS script. But if you have overvalued the goods as opposed to charging the management fee, there could be a potential issue which may come up even in the context of export of goods. Third, GST. Again, one of the biggest challenges is GST, because on an output side, one of the condition to treat this as an export of service that you will have to receive the foreign exchange. Now, if you are charging no difficulty, you could export under bond, export without payment of GST. But if you are not charging and if you are not receiving any consideration, this may lead to a taxability in India being not treated as export because you are not receiving any consideration. And even in terms of the FEMA, This is definitely a short receipt of foreign exchange for the country if you have not been charging adequately the management fee. So whichever perspective that you look at it, whether from the inbound side or outbound side, this issue of management fee or a license fee or a royalty are very critical and a sensitive issue that one needs to be really aware about. I will stop it here. I have spoken too much of India, but we are eager to hear from US perspective and what happening in US in the context of this very topic.
Thank you, Rohit. So there's certainly some key similarities and certainly some key differences between management fees from a US perspective and an Indian perspective. Certainly, management fees and the calculation and their position in the U.S. income tax return is one of the most scrutinized and challenged positions by the IRS, not just from a transfer pricing perspective, but from the perspective of all subjective tax return positions. So, certainly something that the IRS has prioritized and is challenging on a regular basis. Our transfer pricing rules are not specifically aligned with the OECD, although there is sufficient overlap that many parts of it are nearly indistinguishable. They are covered under our Treasury regulations. Many of the items that Rohit's mentioned, there's a lot of overlap here in terms of what allows a management fee to be deductible. It should be supported through a functional analysis. The activity should not be duplicative in nature. There must be a clear demonstration of a benefit that's being ascribed to the party receiving. The activities should not be those that would be conducted by a shareholder, should not be considered stewardship activities. The IRS requires you to look at 6 different possibilities in terms of pricing management fees, and you are generally required to use what they would define as the best method. And finally, a formal intercompany agreement should be in place to support the management fee chargeouts. Generally, in an IRS audit, you have 30 days to produce contemporaneous documentation to support management fees and other types of transfer pricing positions. Ideally, that contemporaneous documentation is in place before you get the knock on the door, certainly from the IRS. This is a list of the different methods. I mentioned 6 methods. There is a 7th method, which is the unspecified method. I won't go through all of these in detail. Many of them very much overlap the OECD, but one method I do want to highlight, which will have relevance in a brief discussion we'll have on the BEAT tax, is the services cost method, which is generally a method that's available for services that are considered to be low margin, low markup services, more routine back office function services, and we'll discuss why that method's important as we move into the discussion of the BEAT. So the most common areas for dispute and services of transactions is the cost base appropriate? Are we appropriately capturing the costs that are ascribed to the benefit of the services that are provided to the related party? Are the appropriate allocation factors selected? So we have a pool of costs. How are we allocating them? Are we allocating it based on revenue? Are we allocating it based on headcount? Is this a reasonable method for charging out these services? And then we mentioned that the various methods that can be chosen, evaluated and then chosen. Are we actually choosing the best method, or are we choosing the method that's providing the best result for the taxpayer? So that's something that the IRS will look very closely at. And then benchmarks. Are we using benchmarks? Are we using comparables from similar companies, or are we pooling benchmarks that will serve in favor of the taxpayer, as opposed to being best aligned and comparable to the businesses that we're dealing with? And then finally, with the services cost method, there has to be a very clear mapping between the service cost and the benefit that it's being ascribed to. And really, the services cost method is what we would generally understand to be a cost plus markup, and it's generally capped at 7% using a reasonable benchmark. And so in order to qualify for that method, you generally have to take comparables and ensure that the cost plus markup is 7% or below. So as far as penalties associated with transfer pricing that the IRS deems to be inappropriate, the penalties range from 20 to 40% depending on the level of the understatement or the overstatement of the charge out. There is an exception, which I believe we all have similar exceptions related to reasonable cause. To the extent you have a formal transfer pricing documentation that's been produced by a reliable third party, you have intercompany agreements in place, you can actually demonstrate that there is an invoice or a related charge for that intercompany service, and the IRS is of course going to want to be able to interview key personnel to validate that the services have actually been performed. So OECD versus the US, as I mentioned, largely overlapping in terms of the different methodologies that are available to us. There is one key distinction that the IRS generally places the burden of proof to validate transfer pricing, charge-outs, and related party pricing on the taxpayer, whereas the OECD would be the reverse. So that's something to keep in mind, and of course gives credence to why it's very important to have your transfer pricing documentation available on the front end and not be scrambling in the case that an audit arises and you're trying to produce a transfer pricing documentation that fits in with charge outs that have previously been placed on tax returns that have already been filed. The IRS has not adopted the MLI. So we have different measures to combat what we perceive to be base erosion abuses, and that would be in the way of the base erosion anti-avoidance tax. So we'll discuss that a bit in the next slide here. So the base erosion anti-avoidance tax is a version of an alternative minimum tax, and the purpose, the policy behind it is to prevent abusive base erosion, of course. We have done away with, in the US, our general alternative minimum tax as it relates to corporations. Individuals still are subject to the AMT. However, obviously a key distinction between the former AMT and the BEAT is the BEAT relates to related party transactions. So the mechanics of the BEAT are such that you have your taxable income computed with what are derived as base erosion payments. You add back the base erosion payments to that taxable income. You apply a 10% tax to that that new base, that new what we call adjusted taxable income. Compare it to the tax that was due on the regular taxable income at 21%. The adjusted taxable income is taxed at 10%, and the IRS would charge the higher of those two percentages. What are base erosion payments? Base erosion payments are typically what we think of with interest, with royalties, and potentially management fees. But they do not include cost of goods sold, which was part of some of the proposed legislation. That was not included. Depreciation on tangible and intangible assets that are purchased from related parties are considered base erosion payments as well. So for companies that are operating at close to break even, and they do have a material amount of base erosion payments, this tax could become very significant. As far as the breadth and the scope of the base erosion tax, it does apply to large corporations. the revenue threshold at which base erosion comes into play, the BEAT tax comes into play, is 500 million US dollars. That is not the consolidated worldwide group. That is specific to the US corporation that's being tested, and there are aggregation rules that would pull in commonly owned US corporations. It can also apply to a foreign branch of a US branch of a foreign corporation as well. So going back to management fees and why it's relevant with BEAT, a base erosion payment does not include the cost element of a management fee that qualifies under the services cost method. So for certain types of management charge-outs that are low value add and are part of a broader management fee, it's become necessary for US companies to take a look at what might be seen as one lump sum management fee and slice that up into different pieces so as to not have the entire thing be construed, the entire payment be construed as a base erosion payment. So we'll get into a very short example here of how the base erosion tax works. This is showing an example of a US company that has outbound payments, third-party outsourced payments to India. In scenario one, there's $1 billion of revenue. We have a service deduction, and we'll assume that this service deduction does not qualify for the SCM exemption, which means it is a base erosion payment, and other deductions, not base erosion payments, arriving at $100 million of US taxable income. Under the base erosion scenario, we would have to add the $500 million back to the $100 million of taxable income, apply a 10% rate onto the recomputed adjusted taxable income, which the 100 plus the 500 would be 600 million. We'd apply a 10% tax to it. You'd have a $60 million tax burden in the US versus in the non-BEAT scenario, a $21 million tax, which is based on our reduced corporate income tax rate, which came down from 35% to 21%. So there's a big difference between here, third-party outsourced and, of course, related party, as BEAT would only apply to related party services. A couple other notes on sales and use tax, which would be our cousin to maybe GST or VAT. Management fees are not subject to sales and use tax, so that's a short discussion. Withholding tax. Services from a US perspective are strictly based on where the services are performed. We don't have the concept of technical services. We do under the US-India treaty, but the definition of technical services from the domestic law perspective in India differ from the definition of technical services in the United States. So one of the issues that can arise there is that where services are being performed in India that under your domestic law are considered to be technical in nature, and there's compensation related to, or, excuse me, if there are services performed in the US that are considered to be technical in nature, and there's a payment, an outbound payment from India to the US, and India tries to levy a withholding tax based on their domestic rules, that withholding tax would not actually be creditable in the US, as the US would say, well, the services were performed in the US, and therefore they're US source services, and they're not eligible for a foreign tax credit. There are provisions in the tax treaty and under our domestic law that may alleviate this, but we do encounter, not just in India, but in other countries where technical services apply, we have to consider ways to avoid double taxation related to those. And that completes the US portion.
Yeah, thank
Guido?
you, Kenny. Of course, before Euro starts, clearly if you compare with India and US, while most of there are similarities, only in one thing we can differentiate in terms of the quantum of penalty. India has never seen 20-40%. Invariably, in every case, it's 100% of the tax amount. is the penalty which would be applicable. And also, while we are the members of OECD, we adopt various OECD principles. But as Kenny was mentioning, that the onus to prove in US is on the taxpayer, equally in India, while OECD suggests otherwise, that you should have onus to be on the tax authorities, but in India it continues to be on the taxpayer to establish that you have done this on arm's length principles and you did actually receive these services from out of India. Over to you, Guido, for Italy perspective.
Good morning to everyone. Just some information regarding Italy that can be applied, let's say, I don't say worldwide, but at least in Europe. First of all, we follow all the OECD guidelines. To this extent, tax authority have not issued so many letters regarding how to manage the management fees, because they rely completely on the OECD guidelines. According to that, for example, in our tax code, provision relating management fees or more on TP matters, because somehow management fees talk directly with TP issue, is just 1 comma of 1 article. The rest is applicable related to the OECD guidelines. To my experience, what is very important, even if of course what is relevant is the substance over the form. What I've noticed that sometimes, very often, well, sometimes in the agreements, management fees agreement, it's provided the general service that in which sometimes it's hidden the royalty component, and this is something that we should really take care, because it's often very well scrutinized by tax authorities, and of course they try to deny well, they try to apply a withholding tax, because for general service, of course, there is no withholding tax applicable, at least from Italian perspective. What is relevant also is to have a tax certificate, even if this is something that has been provided by a letter of the Minister of Finance, a tax certificate of an audit company that states that what its cost, for example, in Italy, its revenues in the other countries, and this has been assessed and declared. And what is also important to underline, this is not just for Italy, but let's say for a European perspective. If you have and it's applicable when, for example, an Indian company has subholding, EU subholding, in which management fees are, from where management fees are charged. When there is an issue on the values of the management fee service, it's possible for a European perspective to apply the EU directive. That it means to leave the 2 countries that are involved in this, let's say, litigation regarding the values of the management fees, not the existence, of course, but the values charged. In this case, the 2 authorities, European authorities that are involved in this process, can be entitled to decide which is the correct amount to be charged from one country to the other country. Of course, this is also something that is possible to apply among Italy and India tax treaty, but it's something that it's, well, personally, I never did it. We tried with US, but it's very not complex, but it has a very long term in terms of time for its as somehow for the duration, while the EU procedure are a little bit shorter on that. As you know, if, as Kenny and Rohit said before, of course, if documents have been managing service have to be well provided and documented. In Italy, as in other countries, you have the penalty protection. In other terms, if you have the documents well prepared and it's in your document in your national documentation regarding TP and of course of management fees, you have penalty protection. It means that in the worst scenario you are entitled to pay only taxes and not penalties. Just a last consideration. This is very Italian consideration. When you have this sort of problems with tax authorities, because of course this is the only situation where you can face the management fees problem, it's always better to anticipate the risk and to ask for rulings or similar institutions, because similar mechanism, because it's very, very difficult to succeed in winning during a tax trial, because anyway it involves transfer pricing concepts that are not very well known by the tax commissions. So it's even better, as Rohit said before, to anticipate in any case the possibility of a tax assessment. And of course management fees are one of the topics that are more assessed by tax authorities.
Thank you, Guido. German perspective, Marcus.
Yeah, I think the German perspective is really short because I think I can concentrate just on the comments to the speeches of the other panelists. I have just 3 or 4 remarks to make. First remark is, and I think this is very much what you have already said, the first thing that we would do in Germany if we are talking about management fees and cross charges is that we really have to analyze what type of service the charge is for. So also in Germany, we would not simply look at the form and say, okay, management fees are management fees, but we more look into the more detail and analyze what type of services have been charged for. Why do we have to analyze this? It's very much the same as you have already approached. It's because we would apply different tax consequences on each of the different services. It may have an influence of different withholding taxes that may apply. It may have an influence on our European GST, which is VAT, but which works very much the same way as it does in India. And of course, the different services may also give rise to different prices. So it is also important that we do a deeper analysis when we are talking about management fees. Second remark to management fees, what is also important to emphasize is that management fees are not fees for genuine shareholder functions. So if there is the thinking that shareholder functions must be charged as management fees, this taxpayer is on the wrong path. You have explained that management fees really just belongs to the management affairs, to the management of the subsidiaries affairs and not to the shareholders. Second remark refers to the GST or VAT. Also in Europe, we also applied VAT on management fees. This, of course, depends a bit, the VAT treatment depends a bit on the type of service. Again, we have to determine where's the place of VATable supply equivalent to your GST supply, and then we also need to adjust what rate we would apply. The rate is not so critical in Germany. Mostly we apply 19% in Germany. I think the rate in Europe goes up to 25 now, but we just have 2 rates. So it's not like India. Documentation is all. Yes, I can emphasize this. Documentation is all. We need to deliver documentation if you want to make your tax transfer pricing system transparent, visible, and if you want to get into an argument with the authorities, you need to provide documentation. Which is to be combined with a clear functional analysis. I think this is everything what already has been mentioned here on the panel. I see my time is up, but maybe one last remark, if I may. That relates to the BEAT issue. We have, in Germany, we have no minimum taxation. However, also Germany has some kind of BEAT mechanism, but that only applies to royalty payments. So in principle, a management fee, if you overvalue management fees, that would never be subject to minimum taxation, at least for the time being. If you have been at this conference yesterday, we have already talked about this new introduction of minimum taxation under Pillar 2 of the OECD approach. So if this comes into existence, we may also talk about minimum taxation on management fees next year. So that's
thank you, Marcus. I think as we've noticed across the country, across the world, this management fee is one of the contentious issue, and the only answer appears to be the documentation. If you have a robust documentation, along with the proper supporting in terms of evidence that what sort of support I have received or I have provided for, and you may have a justified answer before the tax authorities or the regulator. And that's where I think it's very critical for all of us now give focus on this sort of practices, because this very regularly tend to happen that we don't maintain underlying documents and the overall cost being gets just allocated to India. I forgot to mention in my presentation that Indian companies always face a challenge to establish that what sort of those costs are incurred. Our headquarters many a times are reluctant to provide that breakup of cost, and they only provide some sort of a certificate. Now that certificate, if you provide that this is what the total cost incurred, this is what the allocation happened to India business, and this is therefore is justified, it's always difficult that in that context that how that allocation is been done, what has the cost which have gone into considering for the allocation. Now we have seen that we managed from one of the entity outside India and asked them to give us a detailed breakup. It was a banking sector, and it was a detailed breakup have been provided at what sort of cost been incurred, and this is what the basis been used, either sometime on the basis of time spent for India operations, sometime on a generic basis, and the allocations have happened. You won't believe that after giving that detailed statement, the tax authorities have started querying each and every cost. Oh, in this particular cost, what is the India support? Zero, we will disallow this. Now for this particular cost, oh, you have got some support, but we will only allow 2% of that. At the same time, while giving up the detail is also can be a problematic, not giving us the details could also lead to a problem. And we will have to really balance this out very nicely when we get into the sort of issue of justification why this management fee is being paid. And we all know that India won't easily give up. Neither tax authorities won't give up or taxpayers will give up in terms of structuring of this. And I always remember therefore this incident that one person couldn't sleep in the night. And whenever he used to go to a sleep, he says, monkeys are playing in my dream, a football. Every time I go to sleep, monkeys are playing football in my dream. He goes to doctor. Doctor looks at it, gives him a pill. And no problem, go and have this tablet before your sleep today and you will have a peaceful night. Immediately in 5 minutes he comes back and tells doctor, can I start this from tomorrow? So he said, why, what happened? These are playing their final match today in 2 days. We will not give up. Just as tax authorities, we will not give up. Neither taxpayers will give up in relation to this issue. This is very critical an issue as a management fee, which will have to be properly documented up. And we once again thank you, all of you, joining this session at early in the morning. And we now close our sessions. Thank you.